Well, hello members, and welcome to this week's edition of the Weekly Review. We take a look at what happened last week and what it tells us, what we think about the coming weeks. I've been pretty bullish all along here, as you know, and I'm starting to draw in the horns just a little bit. Still positive, but also prudent. And as I go through the show today, I'll show you why I'm thinking that way. I got a little bit of a different take here. I'm starting to do some different numbers so that we can be a little bit more in tune with what's moving where. You know, overall, no matter what you look at this year, right, there's been gains. And there's been big gains in gold, big gains in bonds, even the junk bonds, more so than you've seen in equities. Now, we're seeing selling come into these areas right now as we speak, right? We're seeing interest rates threaten to go up. We're seeing that affect this sector of the market. What we're seeing also is that we're getting some pushback in the equities off that same idea. So, although it's not a pattern yet, in other words, we don't know that gold's going to come in all that much deeper, although it does look like gold's going to struggle for a while. But we do see some losses being registered now when we actually probably should have seen some gains, and that's a little bit concerning. If I flip to another chart that I have here, which is the sectors, let me pull up the sectors. And on this, what I wanted to show you is that, even though when we look back at the equities and see that they have 4 and 5% gains on the year, when you look at the sectors themselves, you've had some tremendous gains across the sectors. The problem is that those sectors that have the largest weightings haven't seen the gains. In particular, I'm talking about the financials, right? And then the other one is technology, which has had it. So financials is about we've got them up here, 23. Financials is about 16% of the market. And then you go down the list, right? Healthcare, right? Negative 3.35%. And go look at healthcare, that's 15% of the market. So you've essentially got 31+% of the market that's either negative, well, actually overall is negative. And that's a big reason this market hasn't been able to push up, even though you're sporting big gains in energy, big gains in technology, and in the utilities. If you go and look at the weightings, 3 1/3. The technology, of course, is big, 26.8, and then not basic materials, but energy, 7, right? So if you've got about 26-33, whereas you have on the other side of it 15 and 15. 30. So that's why the market's struggling overall. Huge gains in certain areas, no gains in other areas where the weightings are heavy. And so maybe this gives us a better picture, of what's taking place. If we look at the technical picture of what's taking place here, the highlights, last week, as I was saying, I was pretty bullish. I thought this market was doing pretty well. I was probably going to get a nice bounce last week, and in fact we got exactly the opposite. And so if we pop into the charts to take a look at it, right, what you're seeing is a market that's filled with uncertainty, and that uncertainty is not allowing it to trade outside this range that's been in effect now for about 2 months. That uncertainty has kind of divided this thing up into 2 areas, right? And we've talked about this quite a bit. So you kind of have these 2 areas. Once it broke up underneath here, you can see that test failure on Friday. So you go down, you test the lows, you can't break it down. You go back up, you try to test back into the top half. You can't get over that. What do? You flip around, and you actually leave a hanging man on Friday. This looks to me like it's going to come right back down here and test again. And so on a short-term basis, I really don't like what I see in that this market can't find buyers at higher prices, definitely find sellers at higher prices, and then on the flip side of that, right, they can't find sellers at the lower prices, at least not so far. If we look at it on a weekly basis, right, you've got these bullish retest regenerate zones that are here and here. Those two areas, right, that is support. That's where it started to come back into last week. Didn't quite hit it, but almost did. If we get a full retest regen, it would be to the bottom of this area. I'll give you some specific numbers on that this week. The thing that's taking place here, though, is that, first of all, let's go back and look at this way. You actually have an ABCD structure to the top side here that hasn't fulfilled, right? Plus you have another one that started here and went to there, and now it was here on the lows, now it's here on the lows, and potentially can even get lower. And so right now, if we do the ABCD structure, we have another one, right? And both of them project to the highs, certainly to higher highs. The problem is that this could dig deeper. Maybe we go to 2085 or 2080 even, which is the bottoms of these zones, and then try to go up, in which case, we barely get back up to this area. It's normal for this to happen. What you don't want to see, though, is you don't want to see deterioration that takes out things that are bullish on this time frame, and that's this area. This is what we have to be concerned with. A break below this gets serious, and it looks to me like we're going to do our best to go down here and test this now. And so my concern is, and my prudence is that if that's really what's setting up, we don't want to wait until we get down there to decide to do something. We have to lighten up here. We have to take out some protection, which is what I did on Friday, and let this thing play out and see if it wants to go deeper. And the deeper one is, on a daily, it's deeper than this. You've got a little ABCD structure here that could take us down into this area, right, the 2105 area. So that's a small one. And then if we go back over to the daily one, right, there's actually a larger one now as a result of what happened on Friday. And that is that we had an ABCD structure here, back up to there, and then back down again. And so we've got, a situation. Actually, I drew that wrong. I was looking at that. I drew it wrong. Sorry. Let's do it again. You got an A to B here. Now the C there, potentially back down deeper, right, which would take us down to those lows on the bullish retest regen on the weeklies. And so, it's that 2085, 2080 area. So when I look at it from this perspective, I don't like what I see. And I don't like it in that, long term it makes me bearish. It doesn't do that. There's still plenty of room for this thing to be bullish. But short term, there's a lot of things that are coming together here that just look like they're going to keep this market range bound at best, and maybe some more deterioration at worst. And we can see that on the sectors, right? We talked about the increasing risk, interest rates. You go down and just look at these charts. As a matter of fact, you don't even have to look at the charts. You can just look here at the bullish bearish, short-term bullish bearishness. You can see that the only thing still bullish, technology, financials. Everything else is going bearish on this short-term time frame. If we look out a little bit, we still have a good setup in that we've only got a couple sideways. Everything else is still bullish. But if we go long enough here, you're going to see these start to change. And when these start to change, 2 or 3 of them, right, go to bearish, we're probably going to see these do the same. And that's the danger, and that's what we're trying to watch for. That's the risk that's out there. You can read through all this. I'm not going to go through all of it. We've got some interest rates that are trying to go up. We got the dollar getting stronger. We got earnings season started. It did not trade well. Let me show you the financials. This sector had 3 major reports come out. Traded higher, right? Opened higher. Closed near the lows. That's not what you want to see. ABCD structure down here as well, potentially, right? If we start back down again, and that would blow out lows. Not good if it happens. So you want to see financials turning around. They haven't done that yet. That's a big piece of what needs to take place. And if we look at some of the names inside that, you can see exactly how heavy they traded. Here's JP Morgan. Started near the highs, finished near the lows. Wells Fargo started near the highs, finishes near the lows. And Bank of America, the same thing. And Citigroup, and I forget which one actually reported last week, but they all basically turned around and headed, right? I think it was Citigroup that reported. Hit the highs, closed at the lows. Couldn't break it out. The good thing is that some of these left volume up there, and maybe they'll try again. The bad thing is that you couldn't hold price on reports that weren't worse than expected. They were better than expected. Now, even though we're seeing this kind of selling, right, we're not seeing some of the areas that you would expect to get hit, getting hit. In other words, I don't see junk bonds selling off. I would expect these to sell off precipitously if we had a lot of fear in the market. I would expect the international bond market to really sell off hard. And so far, it is selling down, but it's not hugely to the downside, right? If you look at the kind of move that it had to the upside. Sure, there's more room here to trade back down as you come down and potentially break a swing point low, which it's about to test. But if it holds up there, then everything, looks hunky-dory. I just don't see the damage in these various bonds that you would expect to see if, in fact, there was a lot of fear in this market. And here's the investment-grade corporate bonds. So that tells me that, maybe this market really isn't in a fear state yet. Now maybe it will get there. If I look at big cap technology, these still look like winners. Apple, Microsoft, Google, Amazon, they all look great. I mean, there's nothing wrong with them yet. The overall percentage of bullish to bearish qualified trends, and one of these days I'm going to actually provide that chart on a regular basis to members when I get more time to actually do things, which actually leads me into another subject, which is that pretty soon we're going to be laying out the final changes that we started at the beginning of this year. We're going to lay out those final changes as to where this site is going and how it affects you, and hopefully how you're going to like it as a result of what we're doing. But one of the things it's going to do is give me more time to do some of these things that I need to be doing to help us all trade better and more efficiently and effectively. So, in general here, my feeling is an odd lot, right? Most things are selling down. We saw that over in the bearish trends that exist on the short-term time frame. But we're still sitting near the highs. I mean, we're not that far off. The financials and the technologies, 40% of the market. If these financials are actually going to sell down, that's going to be a problem because there's nothing else to rotate into right now. You don't see broad strength elsewhere. This is that picture I was just talking about. We got roughly 2 weeks to the election. That's going to put a damper on things to some extent. Earnings season is really kicking up now. This week's the first week of it, full week. The next week or two is really going to tell us what earnings are going to do. I don't want to write it off yet. It's too early. We got some technology. We got some big names this week. We have to see what those do. The interest rates moving higher is an issue if it continues because we got this hawkish talk out of the Fed. So it's just hard to see this market moving that much higher. If I look on the fundamental side, right, you've got some positive. I mean, oil stabilized. It's not rocketing higher, but it's not, diving anymore. And that's a good thing because it should help the financials. The only thing I wonder is, have they already priced that in? Maybe they have. It's hard to tell. I mean, we've got some decent pushes up over the last months in XLF and KBE and the KRE. Maybe they've priced most of it in. I talked last week about domestic growth. It continues to chug along, but these rising rates are a risk. The full week of earnings I talked about is coming up. Here's some of the big names I think you have to put on your plate and look at. And you can see it's a broad spectrum, a much more broader spectrum. It's not just the financials anymore. So we'll see how those are reacted to. And we got a lot more economic data this week. That could be a positive or a negative. We got the Beige Book, the Philly Fed, China data. If they come in so-so or maybe even a little weaker, maybe this interest rate spike comes to a halt. If I think about it from a bottom line, where we're going to go, last week my expectations we probably get a push higher. We didn't even get close. What we did was the most bearish scenario that we had, and that is we went back down in the lower range and tested the lows. What's the best case this week? I think just to push back to those September 16th highs, the ones we were just looking at. I think that's about as good as it's going to get probably. I can't imagine that we're going to get much more than that. If we do, I would certainly welcome it, but I'd be very surprised if we do that. And so the ideal here is that this September 16th low, that bar that I've talked about quite a bit, this one down here, that's the bottom of the range, so to speak. And I think it actually goes down about 2105 probably now. And then you have this bar as kind of a demarcation line between the upper zone and the lower zone. I think we're probably going to trade in this range, maybe test down here, but probably hold in this area somewhere. I think that's the most likely scenario. The best case would be to get up into this area and stay up there just over the top of this dividing line. That would be my best case. Worst case is that not only do we push lower again, but we do a full retest, regenerate off that what is it, the retest regens off the bullish retest regens here on the weekly. So we go all the way down to these lows. In this case, 2080 or maybe even lows 2073. So that's worst case. Most likely is we just range trade. Here's those ABCD structures. There's the 1 to the 2095 area and then the 2105. I think we have a good chance of hitting this one early this week. Best long and short-term ideas. I think Microsoft into earnings is probably a pretty good setup. I thought that last week when I took a position in it. I still think that when I look at it. This chart is set up pretty nicely, right? Big range trade. It keeps finding buyers as it pushes towards the bottom of that range. And if you pull it back on the weekly, that's where it really shines. Is there a risk that it can come down and test into this low? Yes, it is. That's about $55. You're trading at about 57.5. So you got to give up 2.5. But if this does break out, it's a huge ABCD structure to the top side. You can see it here on this weekly. That's a very large, actually it's probably, I can't quite tell, but it's one of these bars, right? But it's a large ABCD structure to the top side if it breaks out. And so there's some big potential here if Microsoft takes off. That would be my best case short term. Of course, that is trading in earnings, which is typically not something you want to do much of. Those best long-term trading ideas still the same that they were, energy and the dollar. And the dollar's definitely been pushing up. I suspect the dollar's going to take a rest here pretty soon. But it is at the point where the dollar actually looks like it's turning. One more time, and I'll pull it up and kind of end the show there. And this, I think, longer term is going to be a problem for the markets. And so what I'm talking about is when we look at this, right, the dollar got the break, broke over this swing point, that swing point, that swing point, and that one over the last 2 weeks. Straight up moonshot. You actually have, the ideal here of an unsustainable type angle. That's one of the things I teach in the mentoring course. And when you get that kind of a move, then of course you have to come back and look at it here. Here it's not that unsustainable yet. Unsustainable here would be something like what we saw back in this area where you just go straight up for 4 or 5 weeks. We're up for 2 weeks now. If we continue on and we go straight up to the top, I would think that would definitely be unsustainable on a longer term time frame. I think probably what we're going to see now that we've broken this swing point high, the probabilities favor a push back to this area. Now, the one thing I would point out is we got a break on multiple time frames. So that says 2 to 3 bars, right, sideways to up before it comes back. So I think the real test is going to be this swing point high if it does continue higher. And if we get up there and fell, then that might usher in the lower prices. You don't want the dollar to go straight up. That's going to bottleneck any kind of equity move whatsoever. All right, that's it for this week. My idea is that we're going to probably trade lower to begin the week, and then we'll see if it stabilizes and tries to bounce. Have a great one.